So guys, you've probably noticed it too. There's been a decent amount of red in the market lately, but for long-term dividend investors, that's not always bad news. In fact, it can mean some of the best buying opportunities we've seen in a while. And in this video, we're going to break down 3 dividend stocks that seem like particularly great buys as we head into October. Real quick though, before we get to those, I want to hear from you. Leave me a comment below and let me know which stocks you currently have your eye on. And also guys, if you want to keep track of how all of my stock picks in this series are performing, I've put together a free public scoreboard where you can see everything all in one place. This spreadsheet tracks how all of my stock picks have done since mentioning them in these videos. And if you want access to this spreadsheet, just click the link in the description of the video or in the pinned comments. Now guys, we actually talked about Watsco pretty recently. I covered it in a video last month talking about 3 stocks that were at their 52-week lows. And the thing is, even though Watsco was at its 52-week low and was looking very cheap, it has actually since sunk to even lower lows and is looking like a better buying opportunity today. And we'll look at those numbers in just a moment. First, in case you've never heard of Watsco, just as a brief overview, they're the country's largest distributor of HVAC products. So they deal with things like heating, air conditioning, and refrigeration, which are always in demand. You know, people will always need to keep their homes and businesses at a comfortable temperature, which helps Watsco to be relatively recession resistant. You know, the demand for this type of company is pretty consistent, and as we'll see, that shows up in the financials. Now, looking at Watsco's share price performance over here on Snapstock, which you can start using right now for all of your stock research and analysis. There's a link to this in the description of the video and in the pinned comment. But as we can see, in the last month, Watsco's down about 2.5%, so it's seen a little drop in the last 30 days. And when we were talking about it in the video from last month, I think it was around 410, maybe 412 bucks a share. So it's pulled back a little bit since then. And if we look at the year-to-date performance, it's really taken a hit. Watsco is down 14.5% just in 2025, which is quite a departure from the rest of the market. And zooming out once more over the last 365 days, Watsco is down even more. It's down almost 19%. So the stock has just really taken a hit. With that though, if we look at the Snap score, we're getting a pretty above average company. I mean, most of these scores look pretty good. Growth is looking rock solid, almost an 8 out of 10. Profitability is a bit on the lower side, but that's because they distribute heavy machinery, heavy equipment, so that's going to be a bit more capital intensive. Debt here gets a 5 out of 10, but I personally think it deserves a higher score. We'll look at that in just a moment. Dividends and buybacks are really solid, almost a 9 out of 10, and capital efficiency is kind of middle of the road, 5.6. But anyway, scrolling down, getting into the growth section, here we can see that for the most part, things have trended up and to the right from top to bottom. Revenue, earnings per share, and free cash flow per share, and most everything's grown at double-digit rates over the last decade. Revenue is the only exception, growing at 7% over the last 10 years, but still, that's pretty consistent revenue growth. I do like to see that. Earnings per share has grown quite a bit, although we do see it has taken a little step back these last couple of years, but still, coming out of the pandemic or comparing pre-pandemic to post-pandemic, the earnings per share has still seen a lot of growth, and the free cash flow has grown pretty aggressively over the last decade at about 15% per year. With that said though, it does look like in the trailing 12 months, free cash flow has seen a bit of a pullback compared to previous years. And if we open this up, get a closer look, and if we switch to the quarterly view, we can actually see that the free cash flow has been negative for the last couple of quarters right here. Now, obviously, it's not ideal to see free cash flow negative anytime, but there is a pretty good explanation for this. Looking at Watsco's free cash flow statement, the company has been spending a lot of money on inventory. And the reason they had to do that is because the HVAC industry just went through a big transition where the old air conditioning systems that used one type of refrigerant were phased out and replaced with new models that use a new type of refrigerant. That's probably the simplest way to explain it. So in making this switch, Watsco had to clear out all of the old inventory, and then they had to replenish it with new inventory so they could have it ready to go for their contractor customers whenever they need it without delay. And while that's temporarily having a negative impact on the free cash flow, we shouldn't look at it as a problem with the business. It's really just the nature of having to navigate through this transition. Plus, in a recent conference, management even said that most of the heavy lifting on all this inventory should be done this year, and by next year they expect inventory levels to kind of start getting back to normal. In the meantime though, while free cash flow has looked a bit messy because of all of that inventory, Watsco's balance sheet could not be cleaner. I mean, last year they actually had negative net debt. Looks like in the trailing 12 months. They do have a little bit of net debt on the balance sheet, but it's nothing to worry about. The net debt to free cash flow is only 0.06, so the net debt could easily be taken care of just from using the free cash flow to pay it off. No problem. And this is why I think the debt score deserves to be higher than whatever it was, like a 5 or a 5.6 out of 10. And the reason it is so low is because it's showing 0 for the interest coverage ratio right here, but that's not the case. At any rate, scrolling down, getting into the good stuff, looking at the dividend stats. Right here it says the yield in the trailing 12 months is 2.65, but if we look at the yield on a forward-looking basis, it's actually a bit higher, sitting at just above 3%. So you're getting a pretty decent yield, and along with that, you're also getting a really solid dividend growth rate. I mean, we can tell right here, the dividend growth has been very consistent, and over the last 5 and 10 years, it's been above 10%. So locking in about a 3% yield with a double-digit growth rate, I think those are very solid dividend stats. And if we scroll down looking at the payout ratios, while the earnings payout ratio is a bit high, this looks to be pretty consistent with where it's normally sat over the last decade. We can see there are periods where it dips up into the 80s and into the 90s, but fortunately the free cash flow payout ratio historically has been a bit lower, usually sitting, it looks like between maybe 50 or 60% on average, although it has jumped up in the trailing 12 months and it is over 100%. And kind of like we were talking about earlier, I expect this to be a temporary issue, and I'd be surprised if it didn't return to a more normal range sometime next year. At the end of the day, Watsco's short-term cash flow issues are really just a side effect of things changing in the industry. So aside from that, with minimal debt and consistent demand for their products, I think this is a great opportunity to buy what looks to be an otherwise very high quality company. So guys, I know we just went over Zoetis like a couple of weeks ago in a video, but this stock just cannot catch a break, and it's really not exclusive to Zoetis either. The entire healthcare seems to be going through something weird. Looking at the performance of the entire sector compared to the S&P 500, we can see in the last month, healthcare really hasn't moved all that much, especially compared to the S&P 500, which is up 3.1%. Zooming out once more, looking at the last 6 months, so basically from about the end of March until now, healthcare is down about 4%, so it's seen a pretty big dip, and it's definitely seeing a departure from what's going on with the S&P, who's up about 15% in this time period. So it's not even close. And then if we zoom out over the last 365 days, the spread widens even more. The S&P is up 16%, but healthcare as a whole is down about 10%. So like I said, it's really been struggling. And looking at Zoetis specifically, like I said, this one just cannot catch a break. It's actually having a pretty good day today as I'm recording this. It's up to about $143.50 per share. But just yesterday, or even a couple days before I was recording this, it was as low as $139, which is the lowest I think I've seen it since I started buying into this stock. But nonetheless, in the last month, it's down 7.6%. So a really big drop. Year to date, that's going to leave Zoetis down 11.14%. So an even bigger drop. And over the last year, the stock is down a whopping at 25.65%. So a really big pullback across the board. And as a lot of you guys know, this is the newest position in my portfolio. I started buying it just a few months ago, kind of right in here, like around the start of April. It was in the high 140s. And if we jump over here looking at my position now on Snowball Analytics, which you can start using for free to track your own portfolios, there's a link to this in the description of the video and also in the pinned comment. But right now I have 52, almost 53 shares of Zoetis at an average cost of $152.39. So with the current share price, what is that, about $9 below my cost basis, that's going to leave me down about 6%, which means that it would be a great time to average down on my position and lower my cost basis, especially with the share price sitting where it's at. It's pretty tempting. And this is especially true when you consider that Zoetis is an incredibly high quality company. The snap score is coming in at 8.3. So really, really nice. And it looks good from top to bottom. Growth is almost a 7 out of 10. Perfect profitability score. Debt's looking good. Dividends and buybacks, capital efficiency from top to bottom. It's just looking rock solid. And if we scroll down looking at the growth charts, this is exactly what you want to see right here. Just consistent growth from top to bottom. And at pretty solid rates too. Over the last 5 years, revenue's grown 8.5%. Earnings per share, just over 12%, and free cash flow about 9.5%. And not only is growth looking solid, I mean, as we saw, the debt got a perfect score, and it looks like for the most part, it stayed pretty steady over the last decade. It has trickled up over these last few years, but it still looks to be in check. The net debt to free cash flow is only 2.25, and the interest coverage is extremely high at about 16 in the trailing 12 months. So that's all looking really good. And if we scroll down to the dividend section, like with growth, as I'm sure you can imagine, this is a very growthy dividend. The starting yield is not very high, high at 1.2% in the trailing 12 months. However, it is quite a bit above both the 5 and 10-year averages, which is really no surprise considering how much of a pullback we've seen in the share price. And the dividend growth rate, I think, more than makes up for the lower starting yield. Both over the 5 and 10-year period, you're getting a dividend growth rate above 20%, which is just astronomical. And the dividend is very well covered too, with an earnings payout ratio about 33% in the trailing 12 months, and the free cash flow payout ratio just a little bit above that at about 40%. Either way, dividends very well covered, and looks like they're consistently buying back shares, and now's a great time to be doing so. So bottom line, Zoetis looks great across the board. I think this is a fantastic buying opportunity, and I'll actually commit to you guys right here, right now. I will start averaging down on my Zoetis position again. It's been maybe a month or so since I've added any shares, but it's just looking too good not to. I have to do it. So FactSet was actually my top dividend stock to buy back in September, and I wrote a pretty extensive article on it just a few weeks ago, and I'll drop a link to that down in the description of the video. I go over the company pretty in depth there, so you should definitely check it out. And you're not going to believe this, but the stock has taken a huge hit just over the past couple of weeks. Looking at the share price performance, it's just insane, guys. It's dropped almost 24% in the last 30 days. And we can see it really started falling off a cliff right in here. And this is where they reported their most recent quarterly earnings. And the reason it dropped so much from the earnings release is twofold. First of all, they missed on the bottom line in this most recent earnings report. They did beat on revenue, which was up about 6% year over year, but earnings per share missed by 8 cents. And even though it was still up 8% year over year, it sent the share price plummeting. And along with that, FactSet also issued some conservative revenue guidance for 2026, and it seems that had a negative impact on the share price as well. Plus, adding to all of that, there are concerns about AI potentially coming in and disrupting this business, making it pretty much irrelevant moving forward. That's a whole nother can of worms. I do go over that in the newsletter article, which once again is linked there in the description. With that said though, zooming out, looking at the year-to-date performance, man, look at this, guys, down 38.5%, just an insane drop. At the start of the year, FactSet was almost $500 a share. That's pretty crazy. But anyway, if we zoom out looking at the performance over the last year, it's down about the same. It's down 36%. Now, just like with the last two that we looked at, we are getting an above average company here with FactSet. The snap score is 7.5, looking pretty good from top to bottom. Nice growth score, almost 7 out of 10. Profitability is looking good. Debt's looking good. Everything here is looking good. And if we scroll down, getting into the growth, kind of like with Zoetis, I mean, everything is consistently straight up and to the right, which is really no surprise. FactSet runs their business on a recurring subscription model, and they have extremely high retention. I think their retention rate for their customers is like 91% or something ridiculous like that. So it's no surprise to see these charts just going straight up and to the right. And they're growing at a pretty solid rate too. Revenue's 10.2% over the last 5 years. Earnings per share is 9.5%. Free cash flow is just a little bit below that, but everything here is looking great. And if we scroll down looking at the debt situation right here, we do see one red flag. And that's because they saw a huge increase in net debt between 2021 and 2022. And this big jump in debt that we're seeing right here was from when they acquired QSIP Global Services. They made a huge acquisition. It was the biggest in the company history, and that's why the debt jumped up so much here. But looks like they've done a decent job of getting that paid down. And at any rate, it's really not too much stress on the balance sheet. I mean, the net debt to free cash flow still, even with the big jump, was only 3.5, but it's since come down to 2.2. So that's more than manageable, and still the interest coverage is very high at about 13 in the trailing 12 months. But anyway, now scrolling down, looking at the dividend stats, kind of like with Zoetis, you know, FactSet's not going to have the highest starting yield. It's coming in about 1.4%, so it's not going to completely knock your socks off. And I will say the dividend growth rate on this one is not as nice as what we saw with Zoetis. I'd much rather get a 20% dividend growth rate with a low starting yield, but still 8%, not too shabby. The dividend growth here is very consistent, and FactSet is actually a dividend aristocrat. I think they've been growing their dividend for 26 years now. Not to mention, if we scroll down looking at the payout ratios, the dividend's very well covered, and it actually looks like the earnings payout ratio has come down over these last few years. So in the trailing 12 months, it's sitting at about 25%. Looks like the free cash flow payout ratio is right there at about the same rate. It's actually slightly lower than the earnings payout ratio. So overall, I think FactSet is looking like another solid contender if you're in the market for another great dividend growth stock. And I actually think the same is true for all three of the companies that we looked at today. With that though, these three are not the only ones. There are still a handful of other companies out there that I think you need to keep your eye on as we head into October. The first one is going to be Blue Owl Capital Corporation, who's seen quite a pullback in the last month. The stock is down 6.6%, taking it from about $14.30 down to where it's at now, $13.30. So it's lost about $1 per share just in the last month. And if we zoom out looking at the year-to-date performance, this is going to leave Blue Owl down about 8%. And look at this starting yield. You're getting an incredibly high yield with this one, coming in at about 13% in the trailing 12 months. And this is by and large the highest yielding stock in my portfolio. But anyway, moving on, Old Dominion is another one that we've talked about quite a bit here on the channel, especially lately because the share price, like some of the others that we've looked at today, really has not been able to catch a break. In the last month, it's down another 12.2%, and it's at $136 per share. That's really low, and it looks like they're having a terrible day today, down 3%. Wow. Anyway, zooming out, looking at the year-to-date performance, Old Dominion is down 22.5%, so another very big drop there. But anyway, moving on, Pool Corporation is another one to watch. The share price is just above $300 per share, and it is down almost 4% in the last 30 days. So a nice little pullback there. And year to date, that's going to leave Pool down about 7.2%. So another good one to watch. Anyway, next up, we have S&P Global Inc., SPGI, a very high quality company, and it operates in the same industry as FactSet. So these two are competitors. In the last month, S&P is down 11.5%, and it looks like they saw a pretty nice pullback right around the same time as FactSet, which is interesting. Anyway, moving on, few stocks are down as much this year as Target. Target just cannot catch a break. It's now below $90 per share, and it is down almost 10% just in the last month. Year to date, this is going to leave Target down 34.65%. And look at these stats right here. PE ratio is almost in the single digits, and the free cash flow yield is at 12%. That is incredibly high. But anyway, moving on, Verisk is another one that I think you should watch. We did talk about this one last month, and since then, it's down even more. It's down 7.6% just in the last 30 days, which is going to leave it down 9.3% year to date. And then next up, we have Wingstop, which has seen a crazy decline. In the last month, the stock is down 27.4%, which is going to leave it down 16.7% year to date. And we talked about Wingstop earlier this year. It was actually somewhere like right in here. And right after we mentioned it in a video, it really shot up to above $350 per share, actually almost approaching $400 per share. And it kind of hovered there for a little bit, but as we can see, it's now making its way back down to reality right here. So definitely a volatile stock, but it also looks to be a really growthy company. So I think if you can catch this one at a low price, it's worth looking into. Anyway, guys, those are all of the stocks that I have my eye on right now. And if you want to see exactly what my portfolio looks like, then check out this next video right over here. In this one, I'm breaking down the top 5 largest positions in my dividend stock portfolio. I'm going to tell you why I own them and also exactly how much each one pays me in dividends every single year. So click right over here to check that out, and I'll see you in the next one.